$13.9 billion. That's how much Elon Musk's wealth grew between 2014 and 2018. His federal income tax rate on that growth? 3.27%. Less than a school teacher. Less than a line cook. Less than you. This wasn't fraud. Nothing you're about to see is illegal. Every move was greenlit by the tax code. Every dollar was protected by a system most people never learn exists. Welcome to the autopsy. In this case file, we're doing something nobody on YouTube has shown you before. We're going to take Elon Musk's $13.9 billion gain, and we're going to reverse engineer it, layer by layer, backwards, until we hit day one. Every structure, every entity, every loan, every clause, every signature. By the end, you will understand the exact blueprint. Not to copy Elon Musk, but to see the game the way he sees it. Before we cut, we need the baseline, the story you've been told. In America, if you earn money, you pay tax. W-2 employee, you pay up to 37% federal. Self-employed, you add 15% on top. Capital gains, you pay 20%. Everybody pays. That's the rule. The ultra-wealthy don't break this rule. They simply make sure nothing they do qualifies as earning money. Here's what the public saw. 2018, Elon Musk on the Forbes billionaires list. Net worth, $24.6 billion. CEO of the world's most valuable car company. Largest shareholder of Tesla. The assumption was obvious. A man this rich must pay hundreds of millions in tax every year. ProPublica's IRS leak showed us the actual number. In 2018, Elon Musk paid zero federal income tax. Not a rounded zero, $0. So here's the question this case file exists to answer. How does a man whose net worth grew by $14 billion pay zero federal tax, legally? The answer is not one trick, it's a stack of four. 4 layers built on top of each other, each perfectly legal on its own. Together, they form the most powerful wealth preservation machine ever designed on American soil. Its name inside private banking circles is 3 words long: buy, borrow, die. Before we cut, 3 ground rules. 1. Nothing in this video is financial, legal, or tax advice. This is a reconstruction of public filings, court records, SEC documents, and investigative journalism. 2. We are not here to judge whether this is right or wrong. We are here to understand how it works. Morality is your job. Mechanics are mine. 3. We reverse engineer. That means we start with the final state and walk backwards. Your job is to watch every layer until the last one, because the last layer is the one that started it all, and it's the one almost nobody explains. We start at the end state, 2018. Musk's wealth, $24 billion. Tax paid, 0. Our first cut is the most visible layer, the one Musk himself has talked about in public interviews without ever quite saying what it really is. He called it, and I'm quoting directly, "I don't take a cash salary." Here's what "I don't take a salary" actually means. Musk's wealth is not cash in a bank account. It's Tesla stock, roughly 20% of Tesla held as common shares. If he sells even 1 share, that's a taxable event. Long-term capital gains, 20% federal, plus California state tax, plus Medicare surcharge. On $1 billion sold, the IRS takes roughly $300 million. Gone. So he doesn't sell. He borrows against the stock instead. Here's how the mechanics work. Musk walks into Morgan Stanley's private wealth division. He pledges a block of Tesla shares as collateral. Let's say $5 billion worth. The bank doesn't take the shares. It takes a security interest in them, a lien. In return, it issues a line of credit, typically at 50% loan-to-value. So on $5 billion pledged, he unlocks $2.5 billion in cash, at interest rates sometimes lower than a mortgage. The IRS sees this transaction and says, nothing happened. And here's why the IRS sees nothing. The 16th Amendment, passed in 1913, gives Congress the power to tax income, not wealth, income. Every court ruling since has confirmed the same thing. A loan is not income, because you have to pay it back. Your mortgage is not taxable income. Your credit card balance is not taxable income. And neither is Elon Musk's $2.5 billion line of credit against his Tesla shares. This is the legal floor the entire playbook rests on. This isn't theory. Tesla's own SEC filings confirm it. As of public disclosures, Musk had pledged over 80 million shares of Tesla as collateral for personal loans. At various points, the value of those pledged shares exceeded tens of billions of dollars. That's tens of billions in collateral, which means, at standard loan-to-value ratios, he had access to billions in tax-free liquidity. He never had to sell. He never had to realize again. He never had to report income. He just spent borrowed money, like a credit card, except the credit limit was a country. Musk is not the only one. Larry Ellison has pledged Oracle shares worth more than $10 billion in collateral. Jeff Bezos has done it with Amazon stock. The Walton heirs built an entire private lending desk around this mechanic. Inside private banking, there's a phrase for this class of client. They call them never sellers. So what does Musk actually do with the borrowed cash? He funds his lifestyle. He buys real estate. He funds new ventures. Famously, he used personal loans and margin against his shares to help finance the $44 billion acquisition of Twitter. None of it triggered capital gains tax. And as long as Tesla stock keeps climbing faster than the interest on the loans, he can roll this forever. The interest compounds. The stock compounds faster. The IRS waits. And in a moment, we'll see why the IRS waits forever. Layer 1 gives him liquidity without tax. But liquidity alone doesn't build a billion-dollar fortune. First, you have to acquire the shares in the first place, and you have to acquire them in a way that does not trigger income tax either. That's layer 2. Regular employees get paid in wages. The IRS taxes wages as ordinary income. Top federal bracket, 37%. Founders and executives don't get paid in wages, they get paid in equity, and equity has its own tax rule book. Musk's compensation package at Tesla is one of the most famous in corporate history. 2012 plan, roughly 5.3 million stock options. 2018 plan, up to 20.3 million more. Stock options are not income on the day they are granted. They are only potentially taxable when they are exercised. And even then, there is a well-known technique to make the tax problem disappear almost entirely. The technique is called a Section 83B election, named after a single paragraph buried in the Internal Revenue Code. Most Americans have never heard of it. Every startup founder worth their salt files one within 30 days of receiving equity. Here's what it does. Normally, if you receive founder stock that vests over 4 years, you pay ordinary income tax each year as the shares vest, based on the market value of the shares at that time. If the company grows from a $100,000 valuation to $1 billion, you get taxed on every step up. Millions in tax before you've sold a single share. An 83B election says, tax me now on all of it at today's valuation. When today's valuation is $1 per share, that tax bill is effectively zero. The criminal investigation continues. Are you ready to solve the mystery? Part 1 was just the beginning. Join us as we delve deeper into case number 001. Click on the screen right now to watch Part 2. You won't want to miss this.